Your safe bond fund can drop even when nobody defaulted, nothing blew up, and every single promise got kept. No company missed a payment. No bank failed. No bond in your fund suddenly exploded. And somehow, the boring, responsible part of your portfolio still went down. That's the part that feels insane. You bought the safe thing. Interest rates went up, which sounds like more interest, better income, good news. So why did your bond fund fall? Here's the puzzle in one sentence. The payment didn't change. Nobody broke a promise. Rates moved in the good direction. And you still lost money. By the end of this video, that won't just make sense. You'll be able to watch it happen. One simple market. One simple seesaw. Let's walk in. Picture a small indoor marketplace. Two stalls face each other across one aisle. Between them, a buyer walks slowly with cash in hand, comparing every deal. The stall on the left sells a bond issued last year. Call it the old coupon stall. Now, the one thing you must understand about a bond is this. A bond is basically a promise to pay you money on a schedule. That payment is called the coupon. But don't picture a complicated finance formula. Picture a paycheck. The coupon is the paycheck, and this paycheck does not get a raise. If the bond says it pays $40 a year, that 40 is printed in ink. It does not change because the news changed. It does not change because rates moved. It does not change because investors panicked. $40 a year. Fixed. Frozen. Printed in ink. Hold that, because this is the load-bearing idea of the whole video. The coupon is the paycheck, and the paycheck is fixed. Now look at the stall on the right. This is the new coupon stall. Same kind of bond. Same basic promise. But this one was issued today. And today, because interest rates have gone up, brand new bonds need to offer more income to attract buyers. So the new coupon stall offers $50 a year. Same market. Same aisle. Two similar promises. But one pays 40, the other pays 50. See the problem forming? Your old bond did not get worse. It still pays exactly what it promised. But suddenly, there is a better deal standing right beside it. The old bond isn't broken. It's just losing the popularity contest. Now here comes the person who decides everything. The picky buyer, cash in hand. Calculator in mind. No loyalty. No emotions. One rule: never overpay. The buyer looks left at the old bond. $40 a year, then looks right at the new bond, $50 a year. Same aisle, same kind of product. So the buyer asks one rude little question. Why would I pay the same price for 40 a year when the stall across the aisle gives me 50? That question is the whole video. Because there is no good answer. At the same price, nobody wants the old bond. And notice what did not happen. The old bond did not default. The issuer did not break its promise. The $40 payment did not disappear. The market never changed the promise. It changed the comparison. That is the part most beginners miss. Your old bond didn't become bad in isolation. It became less attractive next to a better new deal. So how does the old coupon stall fix this? Can it raise the coupon from 40 to 50? No. That paycheck is frozen. That coupon is printed in ink. The old bond cannot give itself a raise. So it has only one tool left. The price tag. The seller lowers the price. Not because the promise broke. Not because the bond stopped paying, but because a smaller paycheck has to cost less upfront to compete with a bigger paycheck next door. That's the whole trick. The payment can't move, so the price moves instead. The coupon is the paycheck. The price is the apology. The price is how the market says, sorry, this bond pays less than the new one, so you don't have to pay as much for it. And that lower price is the drop you see in your account. Nobody lowered the payment. They lowered the price people are willing to pay to get that payment. Say it another way. The coupon is fixed. The price is not. Now look up. Above the whole marketplace hangs a giant scoreboard. It does not care about feelings. It does not care what you paid last month. It only asks one blunt question. How much income do I get for the price I just paid? That scoreboard is yield. Watch what happens. The old bond still pays $40 a year. That number did not change. But now the price tag has dropped. So the scoreboard recalculates. Same $40 of income. Smaller price to buy it. More income per dollar paid. The yield goes up. This is exactly where beginners flip cause and effect. Yields didn't push prices down. Prices falling is what pushing yields up looks like. They are not two separate events. They are two ends of one seesaw. Push the price end down, and the yield end goes up. Lift the price end up, and the yield end goes down. Same motion. Two views. So when you hear, bond prices fall when yields rise, do not picture two different things happening. Picture one board. One end says price. The other end says yield. The price end drops. The yield end rises. That's it. That's the click. That's the bond seesaw. Now, if you only remember the seesaw, you already understand more than most people. But stay for 3 quick upgrades because these are the parts that actually touch your money. Upgrade 1. Why your bond fund can drop when nothing broke. If you buy one single bond and hold it all the way to maturity, the story is different. That bond still pays its fixed coupon. And at maturity, assuming no default, it pays back its face value. So if you truly hold to the end, the price dip along the way may not matter in the same way. If you hold to the end, the dip was a mood, not a loss. But most people do not own one single bond and sit on it until maturity. Most people own a bond fund. And a bond fund is a basket of many bonds, priced every single day based on what those bonds would sell for right now. The fund does not get to ignore today's marketplace. If new bonds now pay more, the old bonds inside the fund must be marked down to compete. So your fund's price drops. No default. No broken promise. No disaster. Just new price tags. This is where beginners mix up 2 completely different fears. A bond fund falling because yields rose is not the same as a bond fund falling because borrowers are going bankrupt. They can look similar on a screen, but they mean very different things. One is the seesaw doing its normal job. The other is actual credit trouble. Your account may show red in both cases, but the mechanism underneath is not the same. Upgrade 2. The seesaw runs both ways. So far, we talked about rates going up, new bonds pay more. Old bonds look less attractive. Old bond prices fall. Yields rise. But turn the rate dial the other way. Imagine rates fall. Now brand new bonds are issued with smaller coupons. Maybe the new coupon stall only pays $30 a year. Suddenly, your old $40 bond looks amazing. It is no longer the stale, underpaying bond. Now it is the star of the market. The picky buyer sees the old bond paying $40, while new bonds pay $30, and says, wait, I want that one. So buyers compete for the old bond. Its price goes up. And because the same $40 payment now costs more to buy, the yield goes down. Same seesaw. Opposite direction. This is why the real rule is not simply rates up, bondholders lose. The better rule is, when new deals get better, old deals get marked down. When new deals get worse, old deals get marked up. The market is always repricing yesterday to be fair next to today. Same event, 2 faces. A frown for today's holder. A grin for tomorrow's buyer. If you already own bonds, rising yields can sting your price today. If you are about to buy, rising yields may give you a better deal. That is why the same financial headline can make one investor groan and another investor smile. They are not necessarily disagreeing. They are sitting on different sides of the seesaw. Upgrade 3. Some bonds swing harder than others. Imagine 2 old bonds. One matures next year. The other matures in 30 years. Both are stuck paying the old $40 coupon. Both now have to compete with newer, higher-paying bonds. Which one needs a bigger discount? The 30-year bond. Why? Because the buyer is stuck with that lower payment for much longer. A 1-year bond only has to apologize for being outpaid for a short time. A 30-year bond has to apologize for 3 decades. So the price has to drop much more to make the deal feel fair. That sensitivity is called duration. But you don't need the formula to remember the picture. Longer lock-in, wider swing. That's why long-term bond funds can move much more violently than short-term bond funds when rates change. Same rate headline, different basket, different swing. So here is the full map. The coupon is the paycheck. And the paycheck is fixed. The price is not fixed. The price is the apology. When new bonds pay more, your old bond does not become broken. It just becomes less attractive by comparison. The market never changed the promise. It changed the comparison. So the picky buyer refuses to overpay. The price tag drops. And the yield scoreboard rises because the same fixed payment now costs less to buy. Price down, yield up. Not 2 events, 1 seesaw. And depending on where you are sitting, already holding or about to buy, single bond or bond fund. Short-term bonds or long-term bonds. That same seesaw can feel like a sting, a shrug, or a gift. The next time a rate headline and your account seem to disagree, you will know exactly which end of the seesaw you are looking at. If that finally made the bond market click, subscribe. We keep turning the financial headlines that sound backwards into simple maps you can actually walk through.